In this training tutorial, I'm going to walk you through option spreads and how to best get the fill price. Taking a look here at Apple, I'm going to walk you through the spread on Apple options. We are after the close here, and you can see here we have the bid and the ask. So just on the weekly options here, at the close, we're talking about, depending on which option, we're looking at 6 cents spread here from the bid to ask, 4 cents here, and 3 cents here, or I'm sorry, 2 cents here, 3 cents here. So these weekly options, there's a bit of a difference. So sometimes the email trade alerts would and will require the weekly options. If we take a look here at the monthlies, you can see here on the monthlies as well that the spreads are about 10 cents here. You got a 3 cent spread here, so the spreads are going to be different in each strike. Now, there are certain strikes or certain contracts that will be what's called penny-wide contracts. The SPY is one of those contracts that offer the penny-wide opportunities. However, when we look here, the spreads are going to be a little bit different in the weekly options compared to the monthly options here. So just because we're after the close, we're seeing spreads a little bit wider. So that's how to look at the option spread. So when it comes to fills and getting a fill price, a lot of times I'm working an order that I've gotten a little bit of a fill on, and I will email the trade alert out, and or there's times where it's getting close to the market close and I'm trying to provide a trade idea, and the price that I'm seeing is just the mid price, and it doesn't mean that it's going to get a fill there. So you have to adjust from those levels. So when we're just looking to buy an option, we could see here that the 575, we're looking at a 20-cent spread. So if we bought just on the offer here, we're paying $3.30. If we sold on the bid, we're selling at $3.10. We're losing 20 cents of this $3 of premium here, which is not what we want. That's why you have to use limit orders. Now, what we're looking to do here is obviously not pay on the offer, and the times that we do pay on the offer, we just got to make sure that we're playing a direction. If you're trading these options very actively, at times you're going to have to pay on the offer if you want to catch a move. You'll get a little bit of a pullback. There's no exact science to it because we're not trading stocks which trade at pennies. We're trading options that are sometimes 5 cents, 10 cents, 20 cents, 30 cents, even 40 cents wide at times. So you have to understand what the difference is between a stock and an option, and why the exact pricing is never going to be what is shown. So if we're just buying a regular option, just like this, you can see here we could put a limit order in, and the likelihood of getting a fill at let's say 206 or 207 is a more probable opportunity to get filled there because we only have one leg. Now if we added a vertical, the more legs that you add, meaning the more contracts, the more contract strikes that we add to this trade, so whatever strategy is involved, the more legs it has. So this one has 2 legs. We're using the 580s and the 585s. It becomes a little bit more difficult to get a fill at exactly the same price that you want. So you always want to use a limit order. Thinkorswim is the platform that I'm on currently, and it defaults by a limit order right away. You can see here we have a market order, limit order, stop limit. These are different types of orders. The traditional ones that you'll use are going to be a market or a limit. Never use a market, because if you use a market, let's say you had the 575 and you wanted to buy at the market, you can see here it's just going to fill you at the worst price possible on this. We want to use a limit order, and that's the orders that I'm typically providing is a limit order. So it's showing right now a 74 cent limit, or sorry, a 74 cent debit limit order, which is a day order, and it's defaulting whichever exchange is giving the whatever best exchange is going to be able to fill this specific trade that I'm looking for. So there's a lot of times where I use those unbalanced butterflies, or let's say a double diagonal. the contracts, when we're looking at those on different types of trades, let's say like on a price line, which the spreads are going to be a lot wider. When we look at price line here, you could see here on these weekly options that the spreads are 30 cents wide here. We're looking at, on the 670s, we're looking at 70-cent spreads here. So the fills are going to be a little bit different, and the pricing of it's going to be. So let's say if we put on a 700 and we bought the unbalanced butterfly, you can see here it's showing at a 17-cent credit. Now, when we look here, we're looking at 25 cents here, 25 cents there, and 25 cents here. Now, if we go up a little bit more and we change this, and now we're showing about a 40-cent credit. This would be something I'm interested in for a trade going into the week ahead, with 700 the key level of resistance, and looking to put this strategy on. Now, it's showing a 40-cent credit. Now, this will change depending on where trades are hitting because the spreads are so wide. So you might get a fill at, let's say, 45 cents, and you put the order in, and it might not get filled there. So you might have to readjust the order and play around with it and sit on it to try to get that fill. There's times where I've provided a trade, let's say that says a 45-cent credit, and like 10 minutes later it's gone up to 65 cents or 75 cents. So it's really, it's a little bit more difficult on getting the exact price that I do provide. Again, if we're just buying a simple option, a call or a put, it's a very good opportunity that you can get the same price or a little bit better or cheaper. Same thing on the longer or on the wider spreads with the more complex strategy, that you can get a better fill at times as well. So there's going to be times where you're going to get not the same exact fill, being that you get the trade a little bit later in the day or an hour later. Of course, the strikes are going to change in price, and the option pricing is going to change as well. So the best way to make sure that you can get the best price possible is to make sure that you're always in front of your email, or you have it set up in the training tutorials that using the Gmail and also using the SMS to forward to your cell phone so you can get that alert ASAP, because the Gmail has been known to get the alerts, the emails, as fast as possible within seconds of me delivering them. So that's going to be able to help you get the best possible price. And a lot of times you'll be able to get a better price than what it's provided. You'll come in and you'll get a better price, and sometimes you won't get the better price. It's just how it is, and it's timing, and it's just how the options work, because we're not working with stock where we can get to pennies. We're working with options where the spreads are going to be a little bit wider, and it's going to dictate on where we can get it. So a lot of times, like I said, I'm looking at spreads on here, and it's taking the mid price when we look at a trade like this where we have 3 legs and we're trying to get filled on these amount of contracts. It's going to make it a little bit difficult, and we're going to have to change the pricing of it around. Again, just focus in on the ideas. Price, obviously you don't want it to be too far away from where I've entered, or the ideal price that I'm talking about. But if it is a price that is not close to where I've provided, then you just pass up on the opportunity and try to find something else. So hopefully that will help you understand of how these fills will work, how to get the best fill, and using the limit orders is very critical, especially in options trading, to be able to make sure that you're not going to get ripped off. Because when you start playing with spreads like in Priceline, when they're 510 by 580, you bought on the offer here. Let's say you had a market order, you buy at 580, and then you say, oops, mistake, and you want to sell it. Well, you've just lost 70 cents on this trade, and on 70 cents on a $5 option, that's a pretty big chunk of change that you've lost. If you think about it, when you buy a car and drive it off and say, whoops, I want to sell it back to you, they're not going to give you the price that you just paid for it. They're going to come in, and this is exactly how the options on these wider spreads will work if you are wrong and you make a mistake on trying to buy it. So if you have any questions, feel free to leave them below, and I will be more than happy to either make another video to help you or answer your questions personally. After you subscribe to the channel below, make sure you head over to optionsizzle.com and download my free report on how I outline the process of finding options that are on the verge for explosive moves.